your opinion, has been the most significant commercial finance industries since we went into lockdown on the 23rd of March?
I mean, that's it's a tough one to answer, because people have been using things like unprecedented, never happened before. So, there are things that have affected bridging commercial, not because we're bridging commercial, but just because we're on the planet. I think confidence levels, and the biggest thing that's affected everything, I think, is government intervention. The breadth of support, whether it's the furlough scheme, which is affected, at least someone that might be furloughed, or the CBIL scheme, for the government to come in and really wrap around. There are very few exclusions where the government hasn't supported. And in some ways that's impacted the lenders. So those two things aside, I think a generality. I think while it's moved constantly, I think the availability of funding, because what is core about alternative finance, about bridging, about commercial finance, is that we're actually in an era where we have so much more choice than just the 5 or 6 high street banks. We've got peer-to-peer, we've got funds, we've got alternative challenger banks, we've got so all of these types of stuff. But what happened very close after the 23rd was an erosion of that. It very much wasn't a complete removal of all lending. So there was opportunities, and I'm sure if you spoke to most brokers, the first thing they did over those next 4 or 5 days, after nursing the fact that the deals that have been in their pipeline couldn't go ahead, I think that the next thing really was to pick up the phone and then speak to lenders, find out what are their situations, are they still going to be able to lend, how are they going to be lend. So what is the most significant change? I think it's got to be availability of funding, albeit caveated with general confidence and the sheer magnitude of government intervention.
Obviously, you're speaking from how much availability of finance there is, and kind of who from the lending community has been available during this time. But on the other side, what has the demand for bridging commercial finance been like during this period of time, and what challenges have you faced in placing business?
I think my personal view is that bridging in particular was designed for times like these. You go back to 2008 when bridging was someone who worked in banking at the time, bridging was maybe a dirty word, for some. But I think through the sheer weight of the people that were involved in from 2008 onwards, and where we are today, and the size of deals that we're doing, the level of complexity, I think bridging, if I'm in the bridging market, I'm actually pretty confident, because actually compared to, say, the commercial market, compared to the high street bank, compared to some of the other areas, we should be confident that we have the people involved to be flexible, to think, we have the intellectual capital to think about how can we do this, not just why we shouldn't do this. And look, at the same time, while I like to talk up the market and talk up the industry, no doubt we all took a pause. We all took a moment to think, right, what does this mean? What does this mean for jobs? What does this mean for property? But I also think, unlike 2008, this industry is not a property-led. This recession is not property-led. It has other fundamental issues, and I think that's why, generally speaking, most people, and I look to the experts. I'm not an expert here, but when you speak to valuers, there is a general mood of confidence into the medium term. There is nothing that's happened that meant that the supply and demand economics in the UK property industry has suddenly changed. It hasn't. I mean, there are questions of pockets, maybe, are HMOs as viable as they used to be in the way in which we see them today? That's a question and that's a challenge that's been brought up by this, but it's still a question I feel like we can answer. In terms of commercial finance, I think they've sort of approached this certainly more cautiously. But again, what are the things that give me confidence is that they have liquidity. The commercial finance lenders have liquidity. The biggest question is where are they going to put the liquidity? How are they going to support, and who are they going to support? Now, that may mean that the industries will work together. So bridging will pick up those people that commercial finance don't fancy picking up today, but commercial finance will still be delivered. And then we'll see over time, perhaps commercial finance coming back. The other thing that's affected commercial finance more generally, I think, is the CBIL scheme and the level of government loans, because it's meant that for commercial lenders, the day job has been pretty hard to do, because you've had a swathe of influx of customers, often directly, sometimes not without their broker. So it's a different beast in terms of information flow, and banks often are struggling. So even today, here we sit in June, and we've got a couple of deals going through at the moment, and I've been told the credit underwriting team are a bit behind, because remember, they're working remotely, all of those challenges. And I think it's great that technology has meant, if this happened in 1980, I think, we would be really super struggling. We wouldn't have this video call right now, but we'd be super struggling. So, we have a lot to be thankful for. But I think from our perspective as Totum, it's been about understanding, working with, you've got to work with what you have, understanding the pressures that lenders are on, and really just explaining to clients that if it's going to take a little while longer, what are their options? Is the best option to take a slightly higher price bridging loan today to move forward? Is it best to look at negotiating something? Is it best to sit tight, communicate with the lender, make sure you're doing all of those right things that you should be doing in order to still get the deal done?
Sure. And you've obviously mentioned that demand hasn't really changed during this time, but since the property market's reopened, how much normality has returned to the industry from a broker's perspective?
So I caveat this in the sense that we're not a volumes broker. We're very much boutique. We work with a small number of clients on the deals that we do. So it's hard for me to say that, oh yeah, we've had a 10% increase in outbound and inbound calls, etc. But what I would say is that I think a lot of people were on the fence, and a lot of people that were on the fence are now saying, we definitely want to look at deals. We maybe haven't found the right deal, and we're not completely sure whether we should be getting the deal of the century, or whether we should be pushing for the deal that still looks good in most times. And there's that sort of decision making, that process is still going on, and they're pushing people hard in terms of driving the right deal. But yeah, I mean, there's no doubt we've seen a spike. But the interesting thing is pairing that with what's happening with the general market. We've seen that. I mean, the Nasdaq's returned to pre-peak. I mean, that's amazing from what I read. I'm not a trader, but and then you've seen the FTSE, something like just low double digits off. Same with the New York Stock Exchange. And it seems to be a lot of people are saying, we get that the numbers over the next 6 months are going to be messy, but our belief is in the next 24 months is going to be strong. And so I think that's where everyone is. Now, the real big question, and this is where politics and what's happening actually impacts all of us, which is, for all of us, we're seeing an ease of the lockdown. And I think in terms of managing people generally, that's fine. I think we're already seeing people start to push the boundaries of what that means. But I think if that leads to a rise in numbers from a pandemic perspective, I think very soon, if we see the government retreat and say, right, we've got to go back into a 2-month lockdown, I think that will be damaging. Because what that will do is, this is all on a thread right now. This is on the basis that it's been bad, but there is daylight, and we have a way forward. And I think if that flips into, well, now we're not sure, and we could have a series of forward and backward lockdowns, and the property market starts and stops and starts and stops, and then I think then it's a very different ballgame.
Out of interest, how is Totum planning for that scenario potentially?
So as a small business, we looked at our cash flow at the start of March, and we made a decision not to make certain capital investments. We we have enough liquidity to probably last us 18 months, and that's a comfortable place for us to be in. We, like many small businesses, we took a bounce back loan really as an insurance policy, because if it's needed, then very grateful for the government for making that available. But really, for me, like I go back to, if we want to do business in this market, I feel that the market that we're in, we are not a hairdresser that needs the physical location to be open. We're not only brokers, but we operate in the bridging and commercial, in the alt space. If we can't do business, it must mean that really that the rest of the market is completely stopped. So I'm very grateful. I mean, I was in 2008 at the bank. I was at RBS and Lloyd's in 2008, and I was at the bank when the banks literally had to stop and couldn't lend. So it's a different situation this time around. I firmly believe, and maybe I'm too glass half full, but I think that we're actually in the right industry to support our clients.
Mm. What one thing, key thing, do you think will contribute the most towards the market recovery post COVID-19?
I think velocity of activity needing to be maintained, and I say that because I think it can only be tempered by a lender's ability to cope with current practices. And probably I just link back to, I think the key thing is, there's lots of little details like surveyors getting the confidence back and starting to see some data points and all of those kind of minutiae details. But I think at the same time, the key thing is that we don't go back into a lockdown, because I think that would be a big issue.
I guess that's something which we can't stop, if you know what I mean.
No, we don't have immediate control over it. Yeah. And I think the other thing I would say is, if consumer demand does not return for whatever reason, and while I don't know the government's books completely, and they've obviously invested a lot already, I think it would take a monumental demand-based investment on the government's part, whether it's infrastructure-led, whatever it is, to really kickstart the economy more than, for example, the Bank of England's current investment plans, where they're buying up all available bonds, putting lots of liquidity in the market. I think that's largely synthetic. Look, they've got way bigger minds looking at it than me, but to my mind, that's quite synthetic. And I think companies can utilize cash and push out and maintain valuations and do all of those things. But actually, if physical consumers are too scared to spend, I think we've got to force that through direct infrastructure spend, because I think if we're starting to see schools, just as an example, expansion of schools, expansion of hospitals, more doctors, more nurses genuinely being hired, and we're getting that infrastructure spend. So this is in a worst case scenario, what I would like, compared to, say, for example, going back to a time where we're not spending anything, we're trying to cut costs. I think we would almost need that government intervention. It's a fine balancing act, but I think that's what we might need if things get really bad.
If we move on to the commercial market, which seems to be, commercial property seems to be hit the hardest during this period of time, what does the landscape look like for funding options right now? And from a broker's perspective, what products are most needed to help commercial clients?
So I think you have to break the client base into sort of 2 or 3 types, which is the existing client who's in pretty good shape, lowly leveraged, and is really just looking at the cash flow impact. So for them, it's all about surety of having strong lenders, because they don't actually have a problem. They have there's a sensitivity to what's happening in the market, but their business is solid. So what they need is strong lenders in the market. So a la 2008, when you had very strong clients being hit because their lenders can't renew or refinance a loan, that's an issue. Whereas they just need strong lenders. And I think the good news is lenders generally, whether it's because they've got new funding lines or because as banks they've been ring fenced certain cash levels or kept their capital levels high, generally they're in a strong position. Then you've got our clients that actually have been hit they've been hit by the closures in the commercial book. Sorry, not commercial book. They've been hit by the bankruptcies of what was great corporate covenants, and it's going to take time to redo. Now, for those guys, I think what's incredibly important is an understanding bank and a bank, and it's a slightly different skill because just refinancing that deal, how attractive is that going to be to a new bank? I'm not sure it's going to be hugely attractive, but what you need is a bank that has enough confidence and time to perhaps use government schemes like C-bills in order to structure something that gives the current bank enough confidence but gives time. Because overnight, like we discussed before, I don't believe that the space itself, we're in the UK, space is at a premium, and whether it ends up that the space ends up being used for a slightly different use, or I always believe British entrepreneurial spirit will find a way to utilize that. But it's the question is how can we give that time? Because if you don't give time, what happens is you end up in a situation where the third lot of people that I'm going to talk about is those that are going to look at distressed situations from our group of number 2, and they're going to want a certain type of funding package to support them, probably on again, not necessarily on the most aggressive basis, but they need lenders that have got a certain amount of confidence over the medium term. And that's not always the easiest thing to do. Sometimes it'll be more bridging. Sometimes maybe it'll be situations where we'll see private equity style investments whereby the debt is effectively shored up, but there's a warrant or whatever to share in the potential risk and therefore reward in the future. That may be something that we will start to see happen. I think, so commercial finance, am I worried as a general point? No, but I think there's a distinct difference between those three types of clients or customers.
You mentioned obviously time is something that's really necessary right now for commercial lenders to give their clients. Do you feel that there's an adequate number of commercial lenders giving that time?
I mean, it's certainly, I think, to be fair to the banks, we're not seeing, and this is, some credit's got to go to the government as well, because I think the pause on repossessions and corporate actions has given lenders pause for thought. The government has also actually made certain changes to the way in which capital would have to absorb the shock of these things. So, for example, if a client is having certain distresses, it's not automatic that becomes an event that means the bank has to hold more capital. So things like that mean that a bank can actually think about supporting the client. And then you combine that with the types of loans on offer. Now, the only problem that does exist is, I do believe, the management team at the very highest level, they are dealing with managing their workforce. So you can imagine all the different processes that they're having to think about each day. They're having to think about things like pandemics. They're having to, I mean, there are challenges every day. I mean, dare I say it without becoming political, but everything happening around Floyd George, they're having to think about Black Lives Matters as a corporate perspective. These are all things that the CEOs and the board are having to think about, as well as then reporting to the government for C-bills, and then also looking after their clients. So I think they themselves, are strained in terms of the amount of time that they can. Obviously, their customers are the building blocks to their business, but realistically, there is a lot of time being taken up on a whole load of different matters. And I think that's why it is taking longer. You know, there's no one across the piece unless you're a small outfit. For the larger commercial lenders, I think they are having to take time.
You make a really good point there. And do you think that this period of reflection that many lenders and brokers in this particular market have had, do you think this was needed in some respects?
I don't. I'm a big believer in the industry, and I think we have lenders that take more risk, and we have lenders that are more conservative, and we have lenders that are opportunistic. But that's what makes the industry great, because I think if we only had 5 high streets, then yes, of course, we will all have to be reflective, because and we have to be reflective all the time. I mean, if anything, all that the last 3 or 4 years have shown us is that the only thing we can guarantee apart from death and taxes now is also change. And so, you know, I think as a lender, we have, I'm not a lender, but as lenders and as an industry, I think we have to constantly take stock. And we have to constantly appraise where our risk position is. But I think as a broker, you know, what is the most important thing for me? It is probably to consistently understand what the whole of market offers. And so I don't think that has changed from before the pandemic to post the pandemic. It's just we probably have to be better at it. That's all. Because our clients are still asking us the same questions, which is, can you fund this? You know, our answers may be more nuanced in terms of our advice. I'm still a big believer that I think when the banks, for 10, 15 years ago, left the advice space, I think more than just getting a deal done, I think the quality of advice that we give our clients, because our deals often will, our clients have to live those deals often for 24 months, 36 months, 5 years. And yes, we're involved at the start, and yes, sometimes we're involved in the middle, but it's really important that the level of advice we give is great, not just for the moment today, but also into the future.
What long-term effect do you think this crisis will have on the bridging industry in particular? And do you think the bridging market will ever return to normal, and should it?
So I think things like credit appetite, like you say, will constantly change. I think some lenders will constantly be assessing what they do. But then for me, all that does, and that's why I love our market, is because there's no huge barrier to entry. Now, sometimes that can be a bad thing because you're not sure who is actually new to the market, who they are, whether they understand lending. But it means that, for example, right now there are huge. I was talking to a wealth manager the other day, and he said how busy he is right now, and the reason is because clients are awash with liquidity that they've taken out of the equity markets, and they need to put it somewhere. Now, when you're looking around for possible returns, the alternative finance space does seem to present a good opportunity. And that's what's great about this industry, because we're not necessarily always operating between 1% and 3%, for example, for prime high street deals. Because the margins are higher, it means that alternative lenders alternatives, not lenders, sorry, but alternative sources, whether it be equity funds, pension funds, etc., can get involved. And not only can they get involved, they can get involved in different ways. So I think one of the other things that lenders are really realizing now is what their funding lines mean. What are the restrictions? What is the impact? Because it's pretty hard if you're an institution that's gone really well, that hasn't made many losses, and your funding line sort of says, we're kind of done right now. We'd like to pause because we lend at 6.5% or 5.5% or 4.5%, whatever it is. And I think it'll be interesting to see whether what needs to happen is more mergers and acquisitions, so that for me that's not as good, because I like more players than less players. But what it might do is it might position lenders in a position whereby they then start to have a more stronger position. So to look at the funding line, and instead of it be having so many restrictions, is to be able to be in a position where you're sort of saying, well, look, we've maybe got first loss on this, and as long as we're comfortable and you're, there'll always be some red lines, so maybe loan to value is X, really leave the decision making to us. But that can't happen unless the power shifts. And I think whether that's due to size or whether that's due to, for example, I think a lot of challenger high street banks, funds are funding bridging lenders. We know this. But would it be different if, for example, pension funds completely cut everyone out and just said, okay, well, there's a pot, off you go? Or, for example, institutional money out of the Middle East or Asia just starts putting that money in. How does the high street, who's got comfortable, lending a bill, 2 bill, 3 billion pounds through smaller institutions, how will they cope? Will they then come back to the table? And then we're able to talk about covenants and power. So that's a really interesting dynamic. I think peer-to-peer is always a really interesting area. I think those guys do a phenomenal job managing the different needs of different kind of groups of investors, together with trying to balance the right project. But clearly, retail investors sometimes can be the first to be spooked, and so that can mean a withdrawal of cash. But it's also saying, how can we evolve? Because my belief is if you talk to people in a way that buys them into the consistent risk profile over time, is that in some ways, oddly enough, retail investors can sometimes be more loyal, right, than institutional, which will make decisions purely on the numbers. I'm not saying one's right or not, but maybe that's a shift. But finally, we've seen noises from the peer-to-peer to see the Bank of England start to support peer-to-peer more directly, and whether the British Business Bank steps that up. And I think if you start to see institutions back peer-to-peer, I think that will be another strand, and it'll change the industry again. Do I think bridging should ever return to normal? I love this industry for the constant change. I wouldn't change it, and I don't think, I'm not someone that believes, in the corporate days, I have done 110% or loan to value for £1 billion out to, but the counterparty was maybe a major oil company, right? And we never lost a penny on those deals. So I'm not someone that should go that says, oh, well, 80% is ridiculous, or 100% is ridiculous, or 75% is ridiculous, or 65%. It's in the structure, it's in the rights, it's in, is it balanced? Of course, 75% is leveraged, without doubt. 80% is leveraged. And if the whole industry was just doing that, I would have concerns, because potentially there's huge losses. But I think we're in this industry because some of the greatest underwriters, principals are there because they can make great commercial decisions. And so I love working with those sorts of people because it's interesting to see their take on it. It doesn't mean that I'm always, it doesn't mean that I'll always happily invest my money in that risk profile, but that's what's great about our industry.
And then finally, just some questions based about you, in case any of our readers haven't met you before. How did you get into the specialist finance industry? And if you weren't working in finance, what would you be doing?
That's the question I was dreading. I'd say, how did I get into it? Well, I was a structured finance, asset finance banker. Project finance. Of all of those things, project finance was what I loved, because there wasn't a set rule. It was like, how can you structure this to make this work? But with the bureaucracy of having bank credit committees and people and credit underwriters and all of those things, it was a great place to learn. Like, as an education piece, I owe a great debt of gratitude to some intelligent people that sat me down and coached me. And when I left in 2015, to be honest, it was just a case of nobody else would have me, because I'd got to a certain level and I realized I had to become a broker and shift to an SME space. And and I was fortunate to join a company called White Rose Finance, and they supported me before I started Totum. And I'm very, very grateful for the industry, because I think it's full of incredible entrepreneurs who just challenge you and have their own agendas. It's different to dealing with sometimes a FTSE listed company can be incredibly dry. I can say that's never the case with my clients. And what else would I be doing? Now, I can't see the resemblance, but apparently I would be a good Will.i.am impersonator. So I guess that's what I'm going with. I'd have to grow my hair, but Will.i.am impersonator.
I love it. You got the glasses. So. Amazing. Thank you so much for your time.